Good evening and welcome to the weekend edition. My name is Peter Reznicek from ShadowTrader.net. Today was the day. The big labor data came out this morning that we talked about last week. Non-farm payrolls and unemployment number. I thought the data was kind of mixed, but the market certainly took it negative. So for today's show, we're going to kind of keep it simple. We're going to look at technicals. We're going to talk a little bit about the fundamentals of that report. We're going to delve a little bit into market internals, see exactly what was going on under the hood during the course of this week. And without further ado, let's get into it. As you know, this show generally deals in technical analysis and not too much on the fundamentals, but today was a little bit different in that the numbers that came out this morning, I felt it was important for us to at least delve a little bit into what was released and what was said, et cetera. So in the data that came out this morning, which was non-farm payrolls and the unemployment number, you can notice that they came in around 142K, but underneath the consensus. And I think that's what the market didn't like. Even though it was higher than the prior, those priors had some revisions downwards. And I think the market might be a little bit afraid that this might get a revision downward as well. The unemployment rate, which we talked about a lot last week, 4.3 was the number to beat, and it actually came in lower, which from my perspective was not exactly what I was expecting. I expected we ticked up a little bit. So we're holding around 4.2. Again, the prior was 4.3. This is where I think it's interesting. This is coming from briefing.com, which I use for news. And I think that they always tend to sort of encapsulate important events really well, sort of give like a in a nutshell type of description. And they say here, the key takeaway from the report is that it was not as good as hoped, but it also wasn't as bad as feared. It was a report, however, that meshes with the understanding that there is a slowdown in hiring activity that should translate into a slowdown for the economy. And that's generally how the market took it, right? If you recall how things were acting today, you had some early strength in the market. You did have overnight activity that was relatively strong early, and then it just sort of fell apart from there. Now, beyond the data, here's the other thing that happened today that I thought was really important. There were some Fed speakers today, and you had a couple of them, but mainly it was this second one here, which is Fed Governor Christopher Waller, who is a voting member, said, quote, "I was a big advocate of front-loading rate hikes with inflation accelerated in 2022, and I will be an advocate of front-loading rate cuts if that is appropriate." So basically what he's saying there is that he's in the camp that he would like to see a bigger cut earlier on, like kick it off with 50 basis, 75 basis or whatever, and front-load that cutting kind of in the earlier part of the rate cutting cycle rather than spreading it out longer. So basically, I think that's important to note. Furthermore, I do not expect this first cut to be the last. So that tells you basically that the Fed is telling us that they're going to be into a cycle of rate cuts. But again, how fast that's going to occur, I don't know. But the main thing is how the market took it. The market did not like this. Obviously, the weakening in the labor market is slowly pointing towards more of a recessionary environment. And this, if they're saying that they want to potentially cut faster, earlier, and that the first cut will definitely not be the last, also kind of tells us that the Fed is somewhat disturbed or concerned, I should say, about an economy slowing down, which could lead to recession. On to what I always think is the absolutely most important portion of this program, where we get into the charts of the broad market, analyze where we came from, where we are currently, and where I think we are headed in the future. Let's head over to the S&P Daily, which is where we always start the show. We had a balance area that was quite long, right in here. And here's where things got a little bit tricky. If you recall last week, we were talking about the potential for the market to actually break out of balance and then maybe have a look above and fail or something. The market never made it. And this was actually somewhat surprising to me, only because you notice that the action right here, which was the day before the bearish drop-off, was literally right up against the top of balance. So there's really no way that anybody could really in their right mind say, oh, this is definitely a short, I'm going to go out short tonight. It would make absolutely no sense. So in this case, the market definitely won in terms of confusing the most amount of traders. Confused me as well a bit, I must admit, because when I saw that, there was no way I was going out short. And to me, that was a positioning for long, especially since we spent so much time in balance and we were up against the upper end. So since then, we've obviously come down in these last 4 days. And here's where things also got a bit tricky as well, is that after we broke down below the low end of balance, notice that there was absolutely no follow through for 2 days. And this also made it kind of tricky in that since you had this huge candle breakdown out of balance, you would expect that the next move would have to be lower, and yet the next day actually failed to make a new lower low, and then the day after that made a new lower low, but actually closed right at that same level, interestingly enough. And then of course that brings us into Friday, where we got the labor data and that sent markets quite lower. After a little bit of a rally early, we did go lower. So I would say a little bit of a confusing market. If you're not yet short this market, don't worry about it. I'm not heavily short either. We're going to give it a couple of days, see how it plays out, see if we get a bounce. And let's look also at some technical levels just below us in terms of how far down this could go if it was to accelerate and keep going. We've got fib levels in the S&P that are very, very important. Also in the NASDAQ, which we're going to get into in a second, but mainly it's the 50% fib right here. And I've got this drawn in exactly to the penny. So you're looking at 53.8532. So just call it 53.85 is going to be your key level next week in the S&P because it is the 50% fib, which simply means that it's the midpoint from where you started down at the bottom to where you ended here all at the top. Halfway between that range is exactly 53.85, and that's where I think the market is going to be potentially heading. Now, looking ahead a little bit further in terms of where somebody could get short this market, what usually happens is that the market needs to bounce a little bit so that it can establish a downtrend line. And we don't know where that downtrend line is going to come in, but sometimes a good rule of thumb is to simply take a point here from the top, right, where the high was, and draw something that's roughly 45 degrees. You'd be surprised how many times that line is very, very close to being about 45 degrees. And watch to see if the price action gets somewhere towards that level, and that could be a short. But again, that remains to be seen. We'll see what happens at the 50. Next week could either go either way. Obviously, it could be hard down. We could continue lower. I don't think there's that much panic yet in this market, which I'll show you in a second when we get into internals. But again, anything can happen. We can always start to accelerate more as we start to go on. Onto the NASDAQ 100, which has been showing a lot of relative weakness, and I think in turn that actually might make it easier for us as traders because that downtrend line is already established. Remember that as the S&P was consolidating straight across in a very bouncy area that had defined highs and lows that were very horizontal, the NDX was doing the same thing, but it was more of a channel sort of moving down, and you can see that here. And that channel moving down has actually established the downtrend line already. So this is going to be interesting right in here on any bounce. Look at the area right around 19,020. Let's just call it 19,000. That's pretty much where when that line comes down early next week, it's going to meet right there. So that actually could be a resistance point in the NASDAQ, even if there's not the same corresponding resistance in the S&P. This may be an area to be looking at to get short this market at around that 19,000 in the NDX. Now, we talked a little bit about the Fibonacci retracements in the S&P in the prior chart, talking about how we have a little bit of a gap left between where we are now and the 50% fib, which would be the midpoint from the recent lows to the recent highs. Given the relative weakness of the NDX, notice that we're already at the 61.8 and we're basically almost sitting right on it. We came within just a hair of it today. It's 18,391.73 is the level that you want to be looking for, and we closed the market today at 18,421. So we're pretty much right there. I'm a big believer that as soon as you get a daily bar close, and it really only takes one, so let's just say that at some point next week, we get a daily bar close like this below the 61.8, it increases the odds greatly that we will then have a 100% retracement to here all the way to the low end of the range. So just keep that in mind. Let's take a little bit of a look under the hood here, which I think is extra important this week because we had some large moves and we want to see if the market internals were actually confirming that. And I think you'll be a little bit surprised when I show you what I'm about to show you in the next screen in terms of the sector action early in the week, which to me didn't really confirm the initial move down on the 3rd. So let's flip over this slide right here. I've taken this snapshot, which I've shown you before. It's just basically some boxes that I have on a screen at all time that are always updating in real time. The amount that the 11 sectors that make up the S&P are advancing from the open on a percentage basis, right? So remember, this is from the open, which is really, really important. And this one here is actually the most important of the three. It's Tuesday, September 3rd, because remember, that's the day that the market fell out of balance and had the first large big body candle to the downside, which closed underneath the balance area. And as I was saying, I'm not heavily short here. And over the course of this week, and I'll show you a little bit in the next segment what I've been doing, but I didn't really get all that aggressive to the downside. And one of those reasons is that I kind of missed it on this day, but I'm not sure if I actually missed it or not, because to me, the numbers weren't really telling me that it was that bearish. It felt a little bit more like the rotational aspect of the markets we've been seeing lately, where if you'll notice, you had some dark red in the tech there in the upper left, that's XLK. about 30% of the S&P, right? Discretionary as well. But look at all the smattering of green here, where especially there in the staples. And that to me was defensive because you see money generally coming out of discretionary or out of tech and into consumer staples, which are much more of a defensive type of sector, right? I always say you don't need the big flat screen TV, but you need rice and beans, right, et cetera. So that's where the staples were coming up. Healthcare also held its own really well there. And financials, which are a very large piece of the market, notice how much they were down from the open by the end of the day, just about 20 basis. So that was really kind of a fake out to me in that, you know, you had strong price action to the downside, probably mostly on the heels of tech, because you can see just how much that tech was down, which was huge, and that had such a big effect on the S&P. But in my experience, and especially in the experience of recently in the market, we've been seeing a lot of reversals come out of nowhere, and a lot of that's been happening because of the rotational aspect. So moving on towards the back end of the week here, Wednesday, same thing, right? That was sort of more of a doji day in the markets and very, very mixed up. And that day you had consumer discretionary actually moving in the opposite direction of the day before, and staples strong again. And look at what happened with technology, right? In complete contrast to the prior day where it's up 73 basis at the end of the day, right? I unfortunately don't have Thursday here only because I forgot to take the snapshot, so I apologize for that. But moving on to Friday, this is where you get a little bit more confirmation. Obviously, this goes hand in hand with the big body candle that we saw to the downside today, but I just wanted to point out kind of how bearish it was because it gives us an idea as to whether or not the move is sustainable or not. So to that end, on Friday, I would say it was not very rotational. You still saw a little bit of relative strength, in staples, right? Makes sense, a little bit defensive. And you saw some relative strength here in real estate. Rates were down, bonds were up, so that makes sense. But look at all of the other 9 sectors of the 11. Everything dark red. Tech down 2.5, financials 1.3, healthcare 2/3 rather of 1%, consumer discretionary down almost 3%. All of these again from the open. So from that standpoint, more confirmation on Friday, but definitely less confirmation in the beginning of the week. While we're still on this subject of how the 11 sectors act on a daily basis from the open, that sort of push-pull that occurs, I wanted to just show you what the weighted AD looks like for the course of the week. This is the graphical representation of those 11 sectors moving from the open in a histogram format. And again, obviously Tuesday was more of a down day. You can see how they came down here. But again, look at the days in the middle when we had those 2 smaller range days. Not a heck of a lot happened. You had activity on both sides. And then one of the main takeaways here is the confirmation on Friday was pretty strong if you look at the weighted AD. And I say that because this absolute number here of 884, that's relatively rare to be coming down that much of 800. You can see it's much greater than here. If you look at this indicator over time, you'll see that 800 readings are relatively rare. Usually you'll be down minus 300, minus 500, etc. And you'll usually have, you know, activity on both sides of zero depending on what type of day it is. But I just want to leave you with this. This is a fantastic indicator. I talk about it all the time. I really do believe that it is the absolute holy grail if there is one. It's just going to keep you on the right side of the market more often than not and give you so much more information. It's available at our site. I've got a link down in the description below if you'd like to check it out. Time now for the play of the week, which this week actually isn't an actual play of the week. It's a little bit more of a discussion on trading psychology and FOMO and chasing moves, basically. So if we head over here to the performance of Weekly Options Advisory, I am very proud to say, as always, I'm one of the few people on the entire internet who tracks every single trade that I do live with my subscribers. That comes out through our dedicated app on the ShadowTrader app, and also in my voice most of the day since I am live for about the first 2.5 to 3 hours of every day. We actually came into this week long the S&P, and this is actually, if we're going to have a play of the week, it would be this one to talk about because I'm actually pretty proud of this trade because we actually turned it into a pretty solid winner here, as you can see, and this is all long the S&P, and we were long coming up into that consolidation area, and then the market just sat there for, as we know, 9 or 10 sessions. We had that long balance area, and that is really very much to the detriment of all options traders, especially when you are long calls. So this is a perfect example of how I manage these trades extremely actively. I'm absolutely unwilling to just put on a debit and let that debit just go to nothing or lose it if the market is not corresponding and doing what I expect. So you can see lots of transactions here. You have to be a little bit nimble. You have to be willing to sell against. You have to be willing to take in credit on the put side if you're long calls, and you have to be willing to take in some call credit above the calls you have. You also have to be willing to morph that trade and change that structure as much as you can. So you start out with vertical, you might change that into a butterfly. Butterfly might become broken wing might become unbalanced, all in the service of collecting credits over and over so that you can get your initial debit down to zero. And that's what we did. We got that debit down to zero, and by the time the market started peeling off and cracking, we were selling the remaining longs, and you can see we had a decent winner there. Now, moving ahead to the rest of the week, again, for me, not that heavy in terms of activity. We are still currently short the S&P, not in major big size, I will admit, and we're also still long volatility, UVXY. We still have a piece of that trade on. We got out of 3/4 of that trade early on in the first move down, and we're still long the last quarter of the trade. So we are basically positioned pretty well. We're short the S&P, long volatility. We're also long bonds in the TLT, and I've been talking up the bond trade for a while, and bonds were extremely strong today. That TLT hitting the 100 mark for the first time in quite a long time. So my take, and also we are short some call credit as well, I should say, in the NDX that came on today. That's for Monday's expiry. So given that if the market doesn't do something crazy and move up 500 points, we should probably have full credit received there. So basically what I wanted to go over here as far as this is that you don't need to, as traders, always be heavy, I should say, in every single move. Keep that in mind. When you run an advisory like I do, it might be a little bit more difficult because obviously I have to perform, right? People pay me to perform, they pay me for trades, and there might be some moves where I'm heavier and some moves where I'm lighter. And in this move, as I was saying, because of how the market acted on that Tuesday with sectors very rotational, then you had two very sideways days. We weren't heavily short positioned into the number on Friday morning. And that also made sense to me because think about it, that number could have gone either way, right? We really don't know how the market's going to act on such an important piece of data. So sometimes that happens where the way the chart's set up, it just makes it hard for you to get in. And by the time you're ready to get in, you may not have good location. And this is very, very important for newer traders. Do not ever, if you can, succumb to that feeling of FOMO, which is fear of missing out. Do not do that, because what you will be doing more than likely is you will be sacrificing good location, okay, in order just to scratch that itch that you need to be in something because the market is moving, okay? This is a marathon, not a sprint. The market is moving all year. There are always going to be moves to be made. I always like to remind my subscribers, and obviously many of you out there who do not trade with me every day, when I am confident of knowing exactly what the market is doing, my advisory is easily in 8 to 10 trades consecutively all at once. Not consecutively, I should say concurrently at the same time. We'll literally have 8, 9, 10 positions on that we're managing at the same time. So you want to basically just let the market guide you. When you know, you know. If you don't know, that's okay too. That's all for the show this week. Short and sweet. Kept it kind of tight with just the technicals, just the fundamentals, a little bit of market internals. I feel like those are the most important things to be looking at as the week develops, right? Over the course of the week, watch those internals yourself. I highly recommend having that weighted AD, iceberg tick, those boxes that I show you. That's a free script that I give to my subscribers. To that end, you can always check it out for just $7 for 1 week. Very, very low risk. The link is in the description right here in the Chiron below. And remember, as always, ShadowTrader will never, ever make you call us or send us an email to cancel a subscription. Obviously, it will renew at the full rate if you don't cancel, but you don't need to call us. You don't need to send an email. It's literally one click. You're just logged into your account to our website, click cancel, and that's that. So it's very, very low risk to you if you'd like to trade with me or my team in the live trading suite. Again, links are in the description below. All right, hit that like and subscribe button and also the bell to be notified when we put out new videos, because it does help the channel. Okay, next week from a technical level, very, very important, what are we going to be looking at? Remember, 50% fib retracement in the S&P and 61.8 in the NDX. NDX is already very, very close to the 61.8. As I was saying, if that index closes a daily bar below that level, it increases the odds greatly that we have 100% retracement, and then the NDX will move all the way back down to what we could call the yen low, I guess, right? Maybe we'll call it the yen low because that was the low that was made on the yen dollar carry trade unwinding. So we'll see. All right. I'll be back at it next week. Maybe, not sure yet, but I might have a special guest next week, which I'm pretty excited about, but I don't want to let the cat out of the bag until it is confirmed. But until then, coming at you from Los Angeles, California, as always, I wish you good trading and good night.